you're ready to buy a home. And now it's time to consider your mortgage options. There's a lot to know about the process, and I'm very happy to be able to help you with this. If you haven't watched any of my videos before, my name is Aisha, and I've been presenting some pretty interesting stuff on homeownership, with the help of my colleague Kayla. There's quite a bit of information to cover on the mortgage process, so settle in and get comfortable, because here we go. Kayla, over to you.
Thanks, Aisha. There are several steps in the mortgage process. First, find a lender. Look at different lenders before choosing one, because they typically have multiple mortgage offerings. There are 4 different types of lenders, and each can help you to obtain a mortgage in different ways. There are lending lead services that are available online only. And there are mortgage brokers who typically work with multiple sources of capital. Of course, there are banks, which tend to have a variety of mortgage offerings. And then there are companies that are not banks, but who specialize in home mortgages. Here is a list of things to consider when choosing a lender. What APR or annual percentage rate are they offering? What different types of loan terms and durations do they have? What are their fees and closing costs? Are they paid upfront or included in the mortgage? How long will each step of the mortgage process take? And what are the available options for the down payment? Okay, you've chosen your lender. Now you can determine which of these mortgages best suits your needs. Here are the most common types. There is a fixed-rate mortgage which offers a consistent interest rate for the entire life of the loan. This means that your monthly payment of principal and interest does not change. Fixed-rate mortgages are available for 10, 15, 20, or 30 years. Loans with longer terms usually have a lower monthly payment. But the total amount you will repay over the term will be higher because you're paying interest on the amount you borrowed over a longer period. If you plan to stay in a home for a long time, or want a consistent mortgage payment amount, a fixed-rate mortgage is usually the way to go. Next, there is an adjustable rate mortgage or ARM. If you get an adjustable rate mortgage, the interest rate can change over the life of your loan. Depending on your loan terms, your interest rate could remain the same for the first adjustment date, which could be 3, 5, or even 7 years. But it could also be adjusted as often as every 6 months throughout the rest of the 10 to 30-year period of your term. Adjustable rate mortgages are often chosen because the interest rates are usually lower than a fixed rate. The risk is that it could increase as interest rates fluctuate, which will increase your payments. Borrowers may choose to go with an ARM when they don't plan on staying in a home long term, or if they expect their income to increase in the next few years. Then there is an interest-only or IO mortgage, which is less common and also has risk. It has an initial period in which your payments only cover the interest costs. None of your payments apply toward the principal amount you owe. Initial rates on IOs are often lower than fixed-rate mortgages. Your payments are smaller in the beginning, but at the end of the interest-only period, they increase significantly to include both interest and principal. Some may even require a balloon payment for the entire balance owing. This type of mortgage adds risk because borrowers must be prepared for the higher payments after the interest-only period ends. And finally, there is the government-guaranteed mortgage, which is offered by the Federal Housing Administration, known as FHA, and the Department of Veterans Affairs, also called VA. If you have income restrictions, currently serve in the military, or are a military veteran, the FHA and VA offer loans with unique benefits and additional flexibility around credit and income guidelines that could help you purchase a home. Down payment requirements are usually lower, and qualifying guidelines more flexible than what you might be eligible for with a private lender. Make sure to let your lender know if you think you qualify for this loan type. Now, to the next step in the mortgage process, deciding whether to get pre-qualified or pre-approved for your mortgage. Pre-qualification gives you an idea of the amount you may be approved for, which indicates the maximum price of the home you may purchase. Pre-qualification is often quick. For a lender to pre-qualify you, the lender will need information about your income and your assets, as well as your credit score. Whereas, with a pre-approval, the lender determines whether you will be approved for a specific loan. For pre-approval, you will need to provide the lender with detailed information and documents supporting your income, your assets, and bank accounts, and the lender will closely analyze your credit report. The process for pre-approval often takes longer than the pre-qualification process. With approval taken care of, you will work with your lender to complete the loan application. Part of this process will require you to order a property appraisal on the house you want to buy. Once you have completed your application, a mortgage officer will send your loan application and your appraisal report to an underwriter who will determine if you can be approved for the mortgage. The final step is the closing. Your purchase offer has been accepted by the seller. You sign the final loan documents. The mortgage and title are recorded. Mortgage and property insurance are purchased. And your down payment is funded. And you are now officially a homeowner.
That covers the essentials of the mortgage process. I hope we were able to clarify things for you. There is still more to know about mortgages. So please look for our video on important mortgage terms. See you next time.